Welcome to Soundbites, Fidelity's podcast where we talk about all things investments. My name is Lucas de Paurbay, and today we'll be talking about the recent reporting season, some of the key observations and portfolio implications. And I'm pleased to be joined today by our leading portfolio managers within the Australian business. I've got Paul Taylor, Zara Lyons and James Abella. Welcome.
Hello, good to be here.
And how have you all survived this reporting season? It's been quite topsy-turvy. How are you all feeling?
Yeah, look, I actually think it's been a pretty reasonable reporting season, actually. I mean, the market is in a buoyant mood, which I think you're reflecting. But we did see some big moves up and down. You know, when companies beat, they went up a long way.
Yep.
And when they missed, they went down a long way. I also see this as another reporting season where it is about individual. To me, it's less about macro, more about individual companies. Even in sectors, we still saw big moves intra-sector. Very quick example. Coles and Woolworths. Coles had a good result, very strong. Woolworths weaker result, very weak, and that's the supermarket. We've got effectively two supermarkets in the country. So, but I think the market's in a pretty buoyant mood, and I thought the reporting season itself was reasonable.
Yeah, sure. Zara, from your perspective, what were some of the key highlights and observations?
Well, I thought the interesting thing was that the financial sector had very strong earnings growth through the period. However, the returns delivered in terms of share price weren't as strong as, say, the materials or mining sector, whereby they had earnings downgrades through reporting season, but actually outperformed by 9%.
Yeah, right.
Yeah, so we saw this sort of bifurcation there between earnings versus share price returns.
And what's been driving that, like out of interest? What's been impacting the fact that you've got some of these companies that maybe earnings aren't as strong, but yet the share prices rebound?
I think, specifically for the banks and materials sector, you saw some optimism around anti-involution measures of Chinese government, potentially cutting down some of the loss-making miners. And then on the banking side, you saw solid results buoyed by very strong credit performance. And because of the easing cash rate cycle, we're seeing both a little bit of credit growth, but also a good benign credit scenario.
Market's probably also looking for or waiting for a rotation between the sectors, aren't they? I mean, that to me, banks have obviously had a fantastic run. Resources have been out of favour for quite a while now, and I think the market's sort of looking for it. We've had a couple of false starts.
Yes, definitely.
Then be interesting to see what happens now. But the market's looking for that, waiting for that as well.
Absolutely, and you did see some runs with lithium players through the period, as well as gold sort of took its foot off the pedal earlier in the quarter, but then has sort of roared back during the last couple of days. So you're seeing those two stocks in those two sectors performing well. Yeah,
I mean, obviously they're very important for Australian investors, given resources are such a big component of the market. And James, in terms of the sort of mid-cap part of the market, I mean, that's been going from strength to strength. I mean, what are your sort of key takers? A little bit different compared to maybe some of the large cap.
There's a lot of growth in mids and smalls, but the sentiment shift has also been quite significant. So resources have been significant upgrades, but also multiple expansions. Consumer was good, technology was good, and I think just the breadth of where things are quite good now has grown through this reporting season. People worried about consumer, people worried about resources, people worrying about costs and productivity and things, and all of that has come through, and people have delivered good margins, delivered good positive outlooks. So that's probably what's happened. The sentiment shift has been quite dramatic. And like Paul mentioned, a lot of the reactions were very significant. So a lot of stocks that are up 10 to 20% in small caps, in autos, in resources, in retail. And that was because either there was fear or there's just more confidence that has come through. So it's quite symbolic of where the market's headspace is. It is definitely optimistic. It is definitely momentum-y. It's definitely more positive and constructive. And the market's more looking at the top line rather than bottom lines and margins and all the fine details. As long as the management teams are looking at positive top line and growth, then the market's being very supportive right now.
Yeah, and that broadening of strength in the market is an important one. Is it a similar experience in the large cap part of the market as well?
I think so. I mean, to follow on from James, it really is a growth so the market's looking for growth. So we did have, a few of the bigger companies deliver. Anyone that delivered strong top line growth, I think the market got excited about, and maybe that's also a belief that they can get on top of the costs. And really, the key issue in this sort of environment is if you can deliver growth, you're in a good position. You can get on top of your costs. But I think so. I think the market's looking for growth.
And you mentioned, and one of the key sort of themes was a little bit of this divergence, where you've had clear winners and I guess clear losers, and you alluded to Coles and Woolies is an interesting one, because you saw Coles do very well and Woolies obviously sell off on the back of reporting season. Is that a common trend at the moment? Are you seeing where it feels like it's very much stock by stock rather than sector by sector, where macro driven market, but you're getting these real sort of individual stock dispersions?
Yeah, I think you got two. I mean, as Zara highlighted, maybe the sector to sector, really the rotation people are looking at is that banks' resources. I think once you delve into the sector, it's then very much about stock specifics. And right at the moment, and this doesn't always happen, but right at the moment, Coles is significantly outperforming Woolworths at all levels. So they're gaining share, they're growing, they've got sales growing, and they're also developing a good, distribution. The distribution centres are working well. They're taking costs out. They're getting on top of any what's called shrinkage or theft within the stores. So they're sort of winning at both the revenue and the cost line, which the market it will reward.
Yeah, and that rotation between, I guess, that sort of resources versus financials, it has been a topic of debate for some time. People have been waiting for when we're going to see this sort of rotation. Now we've seen a little bit of that. And in your view, Zara, do you think is it a structural thing, or do you think it's a bit of a false dawn again?
Oh, that's the
$1 million question.
Yeah, $1 million question. I was going to say $65 million question. Look, I think there's a couple more rate cuts coming. What we've seen historically is that banks have outperformed during RBA rate cutting cycles. And if you can tell me if we're at the end of the rate cutting cycle, then I could probably tell you when we think banks might peter out. But obviously, investors really want miners to work. I think we're only about a year or so into this rotation into banks versus miners. And we still haven't seen the end of earnings downgrades in miners. But as we know, the stocks tend to run ahead of the changes in earnings and look forward rather than backwards.
I think the miners have probably got valuation on their side, which is what investors are looking at.
They do.
Then maybe the banks in particular, maybe at the more expensive end of their range. So I mean, we've had a few things in terms of maybe some more stimulus from China. As Zara pointed out, we've had a couple of mine closures, which have got people excited on lithium. Rare earths are performing really strongly as well, so they actually do have good fundamentals. And gold is just performing well because of, actually a couple of them are because of the gold price, but also good production as well. So I think, they've got valuation on their side over the banks, so that the market, wants to do it, but a couple of times that's happened and really hasn't followed on.
Mm-hmm. And James, the consumer, it's another area of focus for a lot of people. There's, a lot of noise around consumer sentiment. We've talked about for some time now, cost of living pressures, all of those things, but yet the consumer continues to be fairly buoyant. How have you observed
consumers
that
was
part of the
pretty
market?
strong across the board, so particularly in autos and furniture. So the perception is that basically consumer are already expecting the rates to go down, so they're already starting to change their spending habits and starting to spend on things that they maybe enjoy more. And it's a little bit more discretionary rather than staple. So cars and fashion and furniture, those things are now starting to lift up. So Templar Webster had a good result, which is furniture based. The Eagers Automotive had a good result, which is autos. So there's been a number of consumer, I guess the breadth of consumer as well has been pretty broad in terms of companies that have done well, but then sectors that are doing well as well. And then touching back on the resources thing, that's 20% of the index now in mid-caps and smalls.
Wow.
So it is driven by gold mainly,
Yeah.
but it is gold, rare earths, and then copper, and then others.
Okay.
So resources has definitely become a lot more topical in
Yeah,
mid-caps
sure,
and smalls.
sure.
And when it's 20%, the last time that happened was when the last gold rush, but then also the last lithium bubble.
Right.
It got to that sort of
Right.
level as an index.
Right.
So it's become very topical right now
Yeah.
that resources are improving in cycles.
Yeah.
So going back, consumers strong, resources strong, and technology generally pretty good as well. So they're the three that sort of leading the small mid-cap index higher. And that's sort of heading towards 20% return on mid-caps and smalls on a rolling 12-month basis.
Sure.
That's starting to
Your
happen.
technology is probably the growth angle as well, isn't it?
It is
really?
definitely a
That's where
growth angle.
That's where the growth has been.
Yep. Growth, and mainly offshore ones are growing the most.
Yeah. I mean, it's been sort of, fairly positive news, but it hasn't all been positive. Healthcare's been one part of the market which sort of has lagged a little bit. I mean, any sort of observations there in terms of the healthcare sector more broadly?
Well, I know within healthcare, hospitals are obviously have been doing it tough. A lot of their, and at the moment, that's the top line's not growing as much, but the costs that they've got, particularly nursing as well as non-labour, I mean, they're going up much faster than revenues. So you're getting a bit of a margin squeeze, or improvements in that sector aren't necessarily coming through in margin. So hospitals have been doing it, and there's a lot of hospitals, private hospitals, that are not making money at the moment, which is very unusual. So they're probably doing it tough.
Conversely, the private health insurers perform quite well through
Right.
the season in terms of delivering earnings growth and also share price returns because of lower claims utilisation,
Right.
essentially.
Yeah.
So that's been a very strong tailwind, which is possibly may persist. It seems that the consumer has been more inclined to spend on furniture and auto rather
Yeah.
than the knee replacement that you might need.
Yeah.
I guess the other, I mean, and when you talk about the largest, you're thinking through the stocks, the largest healthcare stock, CSL,
Right.
which actually did have a weak result. So they've done a few sort of structural things, but I mean, I guess fundamentally they had a pretty tough result.
Dramatic reaction to that one too.
Yeah,
Very dramatic
big
reaction.
move,
Yeah.
big move.
Yeah.
And they did announce that they were looking to spin off an asset, Securus,
Right.
as well as potentially launching a share buyback in September.
Okay.
But I think they've faced some cyclical headwinds as well as potentially some structural challenges. So the market, it was interesting, that one, because it went up 10% in July,
Yeah.
and then
Yeah.
down 25 in August.
Yeah, well, it goes to that sort of narrative that it's just been a very sort of, if you missed a little bit, you got,
Yes,
the
you
share
got
price got impacted,
absolutely
and
slammed.
absolutely. So in an environment where generally I'm sensing that across the three of you, it's been a fairly positive reporting season. There's been some positive price movement in that sort of world. Valuation, where does that fit in? And is the market sort of focused on valuation, or are they still just focused on growth? There's a common question. Investors do focus on valuation, but to what degree has the market been driven by valuation or other factors in your mind?
Yeah, I think it has been all about growth so far, and I think it's interesting to a certain extent. We in Australia we have a lot of quant funds,
Yeah.
and the quant funds are just looking for upgrades and that growth, and they're sort of buying stocks without linking it back to valuation, or if someone disappoints, they sell it without worrying about valuation as well. So that probably creates some opportunities as well when you get those sort of indiscriminate moves. That does create opportunities. I think it will always come back to valuation in the longer term, but doesn't have to in the shorter term.
Sure.
So maybe some of the quant funds can drive it in the short term, but eventually it has to come back the other way, and that's when they really have a tough time when it moves on valuation.
Yeah. And Zara, yourself, how do you sort of manage those two aspects of managing growth versus valuation in this environment?
Oh, I think it is quite challenging,
Yeah.
definitely. I think we saw like the market increased 3%, but earnings actually went backwards. So you're seeing that wave of liquidity and the weight of money from the index buying really pushing things. So those reactions, I think you just need to keep a calm head and think about what the fundamental opportunities are that present themselves during these market dislocations, or rather stock-specific dislocations. So, and not every... it's very much sector by sector. As James already mentioned, technology performed very well, delivered strong earnings growth, and then you saw other sectors like materials deliver earnings downgrades, but still perform well because of the hope that we're at the bottom, or that there's a
and that's a bit more valuation. I mean, that's actually interesting between the two. Tech's probably still growth.
Yep.
But people are getting, and by resources and materials are the cheapest sector by a long way. So you're probably seeing a bit of both at the moment, which is which could indicate a bit of a turning point.
Okay.
Yes.
Okay. And James, I remember, I think I was chatting to you at one stage, and you sort of gave me a good sort of overview of some of the drivers in the market, and momentum was an interesting one, where particularly in the Australian market, it is a quite strong factor. How does that play into sort of your world? Very high growth part of the market in terms of mid caps, some pretty strong momentum. How do you marry that with valuation?
Yeah, valuations are funny. The overall valuation of the market's not that high. It's around 20 to 21 times, but the earnings are double-digit earnings growth, which is quite high. And if you look at resources, they've come up a lot, but the earnings have come up a lot, and the multiples have come up as well. So that's like a cyclical growth. Then you've got structural growth in tech and consumer tech, and those multiples go from 15 to 100 times nearly. So the range in valuations is very, very wide. But what's interesting now in this reporting season is a lot of momentum has come to those what I call in-betweeners, or kind of more average stocks. So like a stock like Harvey Norman is a good performer, but it's at all-time 10-year high, or all-time or 10-year record highs in terms of share price, because the property's worth more because the search for yield is on. And also the franchisees are doing a lot better because now the volumes in the stores are now doing well. So franchisees profit and the actual property is worth a lot more. So that stock's gone from $4 last year, or nearly $3 to over $7 today. Resource stocks as well, some of them are up 40, 50 to 100%. Consumer names as well. So a lot of these in-betweener kind of stocks, either cyclically good stocks or consumer stocks that are kind of all right, are up 30, 40%. Just because there's a lot of valuation give, or a lot of valuation that can move from stock that's on, say, 15 times to move to market average of 20 times. Doesn't seem like out of the realm of norm. But a lot of stocks that were kind of in-betweeners and kind of okay have been lifted upwards. So there's a lot, it's that the breadth of earnings drivers is also leading to the breadth of valuation drivers, where you got your structural growth, cyclical growth, and then sentiment shift has led the market just higher in mids and smalls. But yeah, the breadth of valuation now is quite large, and there's not a lot of very low valuation stocks anymore. So a lot of things have just moved upward, but they're moving up with earnings, and then some have gone with duration, I guess, building durations long. So let me give that a higher multiple.
Yes.
And then so duration in terms of quality is also, the market's confident, but now also momentum, because the market's positive about the market overall, and the strength of the market and the breadth of the market. They're much happier to put more momentum-based or cyclically based valuations are also lifting up. So quality and momentum is really dominating the market right now, and that's really what happens in the kind of buoyant, confident, long duration mindset. Market that we are in today.
Actually, one of the other, I was just thinking that one of the other things we saw as well was, I think, like the market wants growth, but it's not like, you've eventually got to turn that growth into leverage. So, and that's the thinking. It doesn't have to be in one, but I just saw one of the real standouts for me anyway, in terms of one stock we own quite a lot of, is Seek. Now, Seek the top line has been growing for the last few years, but the bottom line hasn't grown. I think the market got a little bit sceptical of, well, hang on, why is the top line growing but the bottom line staying flat? And as Seek were investing, now Seek was saying, we're investing, which is fine. The market will put up with that for a little while, but they want to see it eventually come through. This actual result was, they had a stunning stock performance, because actually finally they had growth, top line growth, but it came through in the bottom line as well. So, I mean, I just say that because I think the market's happy for growth, but I think you've eventually it's got to eventually come through and leverage as well.
Absolutely. So on the back of taking all those factors into account, and on the back of it, from a portfolio perspective, I mean, has there been any sort of material shifts in your thinking in terms of how the three of you respectively thinking about your portfolio positioning? Has it just sort of cemented the views you already had, or has anything sort of changed and you've sort of adjusted for the next sort of period? Interested in your sort of observations. So maybe Zara with yourself.
I was going to I was just still on a thought from before, which was that this reporting season was one of the key reporting seasons that every report talked about AI and how that was going to change the business. Well, not necessarily change the business model, but the investment being made for AI and the potential for it to change the business model. And it's
take out costs,
convey benefits to the employees, convey benefits to the customers, and one hopes convey benefits to the shareholders. And so that's been a key line of interrogation with the companies to get a sense of where that's going. And clearly they're making the investment now, but no company has come out and quantified what the potential benefits are.
Yeah.
So that's another thing
they
to bear in mind.
Themselves, I guess, which is the main thing,
which you just reminded me with your Seek analogy. So that there is potential for operating leverage coming through, particularly in the banks, which are very big spenders in technology and incrementally spending more in the AI piece. And financial services, banks, insurers, even Zip talked about the number of benefits that they have that may be able to etch out from using AI, from all sorts of things, from HR to legal, compliance,
call centres.
There was a number of different avenues that were called out by the companies calls that I listened to. Anyway, sorry, I diverted from the original question.
That's an interesting point, because just on that, before we get to the portfolio element, I mean, do you think obviously there's a lot of headline news around AI more generally.
Yes.
And obviously some big companies globally benefiting from that thematic as well. I mean, do you feel like from an Australian perspective, in terms of these companies looking at it, do you think it's a structural thing in terms of that, this is really going to be part of how a lot of companies operate, having AI involved in some shape or form?
I believe so. I certainly think they're all at least dipping their toe in the water to get a sense of how it can be used responsibly within the businesses. And yes, I think there is definitely scope to expand. Even within our own business, there's opportunities. So I think there is
quite exciting. I mean, when you think about it, it's super exciting. And maybe even, we all started by saying the market's in a buoyant frame of mind. I mean, to me, AI is a contributing factor. Like, we don't really know how much, but we know it's the likelihood is it's going to be positive and significantly positive. So maybe that's just part of the mindset of the market, maybe.
Yeah. Well, I know the newspaper headlines focus on labour reductions, but I actually think it's more likely that it'll just you're upskilling your labour rather than it being a sort of complementary rather than it being a replacement.
Yeah, and the productivity issue, right, which has been an issue for some years now.
Yes,
so, absolutely.
So sorry, you asked me about
So that's fine. I think
shifts.
it's a relevant one and definitely topical as well.
Yep.
So in terms of when you sort of wrap all that up from a portfolio perspective, whether it's AI or whatever it may be, some of these thematics coming through, has it changed in terms of the shape of your portfolio, where you are taking risk, where you're not taking risk? Has anything changed, or sort of has this reporting season really just reaffirmed your views on the market?
I haven't personally made any major shifts through August. It's like drinking from the fire hydrant, really, getting all the information.
Yes.
And I think it's important to distill it all and work that through it. But I have had occasions where I've trimmed names where I've lost a little bit of conviction or concern that there's more of a structural shift going on in terms of market share loss. But also added. Well, just before reporting season, added to Cochlear, for example, which has a new cochlear implant called the Nexus, which has potential benefits to improve hearing outcomes for both the recipient as well as for the surgeons in implanting the implant. So that's sort of a 2 to 3 year type story.
Yeah.
But that's one name that I've added over the last quarter.
Sure. Paul, from your perspective, any sort of key?
Yeah, maybe from a
changes?
sectoral perspective, I've probably added to, as we talked about consumer discretionary, I've probably added to. I think with interest rates coming back down and the consumer already being relatively buoyant, and particularly for Australia, we've still got reasonable population growth. So even without an individual buoyancy, you've got demand coming through. So I've added to that sort of consumer discretionary area. I have added a little bit to resources as well, but I'm definitely looking at that as well, spending quite a bit of time. And that's probably more the sub-segments of resources, taking a little bit away from like maybe defensive type, some of the some healthcare, and we talked about that, as well as some staples,
Right.
taking a little bit of money away. I've probably stayed strong technology. We've talked about some of those stocks. Yeah, so probably just added a little bit to consumer discretionary, in that sort of area.
Yeah. James, from your perspective?
Yeah, similar actually moves
Yeah.
to Paul's. So consumer resources and then added defensives like just pure yield or very low growth value type businesses. Moving more to where there is growth, where there is opportunity for companies to grow top lines.
Yeah.
And companies that are low growth, like below 5% growth, I think is going to be very far out of where the market is for the next 12 months, and they're unlikely to perform well. So really going where there is growth and also certainty, but then also keeping a balance with things that are going to do well if things do slow down a little bit. But the majority of the portfolio is still towards that growth angle and tilted more towards that slightly during this reporting season.
Yeah. Okay, that's interesting. So fairly consistent with sort of your initial 3 of your overall comments on the market, and certainly feels like a continued pro-growth sort of mix in terms of the portfolios. Maybe just one final question from me, and I guess it's a bit of a, getting to, what you guys think about for the next sort of 12 months and beyond. If you had to pick sort of the one thing that you're focused on at the moment, either positive or negative, could be either in terms of the market, the portfolio, what's the one thing you're focusing at the moment and you think investors, it's worth them focusing on over the next coming period?
Yeah. One thing's always difficult, but I mean, I guess if you're going to do one thing, probably that growth, and say looking for who does have the growth.
Yeah.
Who is investing? I mean, to get the growth, often you've got to invest. Who has been investing?
Yeah.
Because there is a lot. You think about all those different areas. There is a lot of growth out there, but it is in pockets.
Yes.
If I can put it that way.
Yeah.
So we spend a lot of our time talking to individual but that actually interesting thing is even that's not just about sectors. Like I said, at the moment Coles is significantly outgrowing Woolworths. They're not just better cost performance. So even in a subsector, for a fund manager that's doing well is going to be growing strongly. One that's maybe is not growing.
Yeah.
So it is spending time. You want to be on top of the individual stock. You want to look at the trends, but then you want to look at which companies are delivering it. You want that fundamental bottom up approach to which companies are delivering the growth.
So growth. That's the summary.
I think so, but I mean, I want to put the caveat on that it's not just financials growth or resources growth. It's actually which company is doing it within that subsector or sector.
The fundamentals of drivers. Zara, for yourself?
Yeah, well, I would echo Paul's sentiments first off, but secondly, I'm looking closely at the companies that have made big acquisitions and trying to understand, how that shifts the dial for those companies, and also looking at the leverage that was implied, because there are a number of companies that made acquisitions. The street sort of got confused about where the consensus estimates may have over or under-egged the potential earnings impact of those said acquisitions to the businesses. So really trying to get a handle on that dynamic to see, what the potential is for synergies or otherwise, or the risks for leveraging issues.
Yeah, so
debt
M&A.
leverage.
Are we seeing more, just out of interest, are we seeing more of that at the moment, or?
It feels like we are.
Yeah, we are. Globally, it's near records.
Yeah, right, okay.
M&A activity.
Yeah, globally.
Okay.
And, you've got Santos had a bid made for it, so locally we're seeing a little bit of action, but not.
Yeah, I think you've seen Santos, you've seen Domain. CoStar has picked up Domain, so that's out of the market. One of our other stocks, Lynch, is currently there's an offer for it to be taken out by a private equity firm as well. Yeah, so you are seeing a bit of that.
James, from your perspective,
I'd say growth certainty is what I'd say. So I think it's a very quality momentum cheerleading market is what I describe it as. And in that, you've got to be careful of the other side of it, the risks. So that's complacency, capex and competition. That's typically where that paradigm starts to slow itself down. So complacency of management, complacency of investors, etc. But then competition can start to emerge too. If returns are too good or valuations are too good, eventually competition comes in either capital or genuine competition. I think that they're the things you've got to keep in mind. And we'll mention capex as well, because then as things get more growth orientated, people do start to spend more. And then as that competition starts to lift, you need to increase your capex, which means the returns eventually fall. If returns fade, then valuation should eventually follow. So, it feels like it is a very good quality momentum type market, but I think they're the sort of concerns you need to have in your mind as you continue to follow this growth trajectory that the world's on really now.
I mean, that's, if I sort of put it all that together, so growth, but growth driven by fundamentals, M&A, maybe are some parts of the market maybe over exuberant or under exuberant, whatever the word is. Yeah. And then obviously complacency, which is an important one, particularly in a momentum market where it's easy to sort of just see
sort
of
the
blue sky the whole time, right?
Yeah.
So thank you very much. I think that was a fascinating discussion and some really interesting topics covered. Thank you.
Cool.
Great.
Thank you.
Thank you.